Let's start with your bad debt line. That's where we always focus on the banking front. Down 8.5% on the prior period. How quickly can we reduce further the bad debts effectively?
I think the next 6 months are still probably fairly tough, and I think it'll start unwinding from here on out. So we did say last year that we thought bad debts would be lower. They're stickier than I thought, but I do believe they'll start unwinding next year, unless Ireland blows up or something else goes wrong with the world, which I don't think is a possibility, but there's maybe a small probability of that happening.
And this diversification of the business, so to speak, into the asset management and away from the lending practices, how aggressive is that going to continue to be in Investec's future?
Well, we drive every business as aggressively as we can for what markets we face. So we have made it clear that we want to build non-banking revenue or non-lending revenue. Banking revenue we're still very happy with. We're happy with lending revenue, but we want to build the other side of the balance sheet faster, and that's really the point we're making. And I know when you see all the new capital requirements coming at you from the Bank of International Settlements and all those kinds of things, it can make lending a very onerous business. That's why I thought I could give you a very good answer for Jill Marcus's point this afternoon, because I was listening. But cost to the consumer at the end of the day is going to rise, because banks have to hold a lot more capital, and at the end of the day investors will want still some kind of decent return on equity, and this all has to be divided up between the various parties in a effective way. And that's really about you had a crisis, banks lent very tightly to the wrong people, and they had bad debts as a consequence, and there was no cover.
There was talk some time ago, in fact fairly recently, about actually splitting off asset management. I don't know whether there was rumour or whether it was under discussion.
It was Bloomberg getting the wrong end of the stick and blasting it around the world. So the minute they asked any of us who would have the ability to buy or sell that business, the answer was a categoric no.
Now, of course, I mean, it's quite obvious from the results that this is where huge margins or larger margins are made and more profit is. So it is.
Well, it's non-capital intensive, so it balances the capital intensity of lending.
Now, Stephen, how you operate obviously extensively in the UK. What's it like there? What's the property market? What's the pound going to do? Because, I mean, if there's any chance of recovery in the developed markets, I mean, surely, given what's happened to the pound, that the UK stands a chance of being one of the better ones, better recovery.
Yeah, I think the weakness of the pound is supporting the system. I think when you're physically in the UK, you don't really feel that there's a big problem. Obviously, some people on the ground feel that there's a big problem. Remember, unemployment there is still quite a lot lower than the US, and maybe this austerity package will hurt unemployment in the public sector, but hopefully, the Bank of England, through whatever policies they implement, will alleviate it in the private sector. And so it doesn't feel as bad. Our UK business has performed fairly well. Our problem loans in the UK specific, or if I go, we're mainly in London, have been fairly moderate in London. Our problems really were, we had a very small book, 1.6% of our book in Ireland, makes up 15% of our global defaults, because that place is a bit of a basket case. But the UK itself, doesn't feel so bad. In fact, our economist almost said that you're almost in a V-shaped recovery, which I would question, but it's not too bad. I think the bigger issue there is obviously the banks were badly damaged, the major banks, and they took in a lot of money from the government, so they have to implement austerity, and therefore, I think growth is going to be stop-start, but with a weak pound, and I think that's helped them a hell of a lot. And they're not really an export country, but their exports have done particularly well, and people visit there because it's cheap.
The South African operation was exceptional. I don't know whether that was the rand, the strong rand, or the translation.
No, it was a strong rand had a part in it.
But it's still a very good result, because I think most of it accounted for something like 65% now of your operating profit versus under 60% last time. The question I want to ask is that if you look at other banks in South Africa, they're not doing that. They're not creating the same kind of growth as you are in this market.
Yeah, I think that we grew in 5 of our core businesses, we were backward in, well, actually the private bank in South Africa was better this 6 months than last 6 months. Where we're suffering like the other banks is on the reinvestment rate of our capital. You know, we earn naught in England. That's on, you know, £1.5 billion. You earn half if you're lucky, or maybe 3/4, depending where you put your money. And here you're earning 5 or 6% on almost 20 billion rand. So that is a big, I don't want to call it a hole, but a big piece of income that you have to find in other activities, which is not so easy. So, you know, when life normalizes, you're going to get lower bad debts because life is good, and you're going to have higher earnings on your free capital when interest rates actually come back to a normal space.
Does this account for that, you know, the corporate side of it? Is
well,
that
last year we had a buyback, a debt buyback.
Right.
That was 46 million quid. That's not repeated.
Okay.
But there's another 10 to 12 million pounds that was there last year that was not there this year from lower interest rates.
There are media websites out there drawing comparisons with the cost-to-income ratio that Investec came out with this half to that of Standard Bank. And your cost-to-income ratio is sitting at 61.4%. It's up from around 56% in the corresponding period in 2009. Now, Standard Bank has got a cost-to-income ratio of 58%. And I think Bernard Cantor had to field questions on whether you were going to consider going the same route as Standard Bank with retrenchments.
Well, we're a totally different business to Standard Bank. So if you take a cost-to-income ratio in an asset management business, that is between 65 and 70%. In our wealth management business, you're lucky if it's below 70%. So you know, the minute that becomes a bigger component of our business, so that cost-to-income ratio is going to shift upwards. And that's why we set a target of below 65. We didn't set a target of below 55 or below 60. Because we understand that if we're going to drive our business model in that direction, that's what's going to happen. So when you build operationally leveraged businesses, which those businesses that don't use capital but they need people, your cost-to-income ratio is always much higher. And you can go and look at any cost-to-income ratio of any firm of that type, you'll find it in the 70s. Go and look at Macquarie's cost-to-income ratio and see where that is. It's well into the 70s.
Bernard took it one step further and he said it's not an Investec's culture to retrench.
Yeah, we don't like hiring people and then retrenching them. We'd rather fire them for incompetence if they're incompetent. But we, you know, hopefully we manage our business well enough day to day that we don't have to go through these major retrenchment processes. Yes, there are seasons when we had to do it in Australia 2 years ago because of circumstances, but it's not something that would be foremost in our mind. We'd rather say, you're not competent, it's not working out, let's come to a mutually agreeable arrangement, finished.
Now, Stephen, when we discuss the valuation of banking shares and how banks work, etc., there's half of our team says when interest rates are cut, it's bad news for banking shares because you earn less on your capital, as you said earlier on. It's the so-called endowment effect. And the other half say, but surely lower interest rates will mean higher asset growth and lower debt, so lower interest rates are better for banking shares. Is it just a timing issue? What do you think?
Well, I think that, you know, when you operate outside of South Africa, you used to earning a low return on your free capital, and therefore the business has to run quite a lot harder to generate a fancy return. I think that it's probably better to have lower interest rates, recognizing that you lose the endowment effect, because that creates economic activity. If the interest rates are low, because the structure of an economy is good, not because you've been through a crisis. I think we've got low interest rates right now. Our structure of our economy, as you guys, I mean, will probably agree with, is fairly sound. I'm talking about the monetary and fiscal policy side of life, not the employment side of life. But, you know, our interest rates have come down to the point they've come down because of what's going on in the global world, because there's low levels of demand, because inflation is not really a threat at this point in time. And I was listening to what, I can't remember if it was Jeff or Gulam was saying earlier on in the conversation, but, you know, I don't see inflation as a threat for, or you were saying it actually, a reasonable period of time. Because there's just nothing going on. There's surplus capacity in the world.
Well, on that point, you've been very vocal about the fact that interest rates haven't been cut quickly and aggressively enough in South Africa. And Annabelle Bishop, obviously a group economist at Investec South Africa, mirroring what you were saying, looking for a 1% cut, 50 basis points now in January. Do you think that we should have seen a more aggressive cut today?
I don't, I was fairly happy with the cut. I knew that's where they would go. I didn't feel that they would go too aggressively because they've still got these other issues lurking outside there. What's going on in Europe is still a big issue. And, if it blows up the wrong way, these flows that we've been getting in South Africa can turn around. Just go and read Paul Krugman's book, Return to Depression Economics, and see what happened to Thailand or Mexico and all those countries when the flows start turning around. So I think a 50-point cut is probably fair game. I think that we could also do something on the buying of dollars side. I think if you look at the guy's governor of the Bank of Israel, he's bought dollars very aggressively. He's built his reserves from $20 billion to $65 billion over the last couple of years. And obviously his currency is quite strong against the dollar, but that's what he's done. And he's the guy who taught Bernanke, he's the guy who taught Krugman and all these guys about economics. He's actually a Zimbabwean married to a Cape Townian. Stan Fisher's his name.
Fisher, yeah.
And but if you look, he's been very aggressive in building up reserves. And I think we could be more aggressive in building up reserves, but maybe Treasury don't want to absorb the cost, that 5% cost of the interest differential, because it just will hit the budget. I don't know what the politics are, but...
I must just clarify, Annabelle's view was actually in line with consensus for a 50 basis point cut now, but she was saying that there's not much harm in going 1% and making a more aggressive cut.
Yeah, our rates are still relatively high. Real rates are higher than most other parts of the world.
This is, most of the viewers are buyers of shares or looking for investments. And just to change track a bit,
you're going to ask him the same question you asked Gulam and Jeff,
an
where you should be putting your money now.
Well, it's in a way,
Okay,
in a way, do we buy banks is the ultimate question. But where do you see the banking industry 5-10 years time in this kind of environment where we may be going into a period of 2 years of what did he call it?
Subdued,
anemic growth.
It was below normal
growth. Global growth.
Well, global and South Africa as well. And also where you have huge regulatory demands coming on banks. You can't go into private equity, cut your trading book, etc. So, what do you think about, where do you think you're going to take Investec, or where do you think banks will be?
Well, we as a different type of bank, but I think that if you look at some of that stuff's American, it's not going to come to Europe probably. But what is going to hurt banks' ROEs right now and for the next while is the enhanced capital that is required by banks. And this is still not clear because they've taken away or proposed to take away a whole lot of instruments like sub-debt and innovative perpetuals, or all sorts of funny instruments that banks used as capital that really provided good protection to depositors, but didn't help regulators when they had to seize a bank. So I'm sure they'll work this out, that what they're doing is not that wise, that they're going a bit too far to the other side. But banks will probably have a fairly tough period. But over time, I think they'll realign their business models to make sense of what they should be. I mean, there are politicians who want them just to be pure utilities. Where, which is, you remember what they were like, they called them 3 + 3, plus 3. You used to borrow at 3, margin of 3%, and go to golf at 3. That was what bankers were. It was a very easy job as a bank manager. I think it's a very different place today.
But there is pressure being put on, for example, your private equity side, investments in that, because you can't turn it into liquidity should you need to do so.
Yeah, but some regulators have just said, okay, you'll have to hold more capital for that.
Which is what you're doing. You're being very conservative at the moment until we've got clarity in the regulatory environment, aren't you?
Yeah, but we have to hold more capital for private equity anyway. I mean, the regulator said, we want you to hold more capital for private equity. Fine. It's not such a big part of your business that causes too much disruption. Your real thing that eats capital are the big loan books. And if you were a European bank gearing 40 to 60 times, even though they played all tricks to get that kind of gearing, and that's why margins were very tight, because they were geared very high, so they gave money away at very low margins because it still gave them the right kind of ROE. And that's why it eventually just burst. Because if you geared 60 times, doesn't matter what you are holding in your portfolio, 2% adjustment in value, so if something goes from 100% to 98% poof, you're gone. And that's what happened. So, you know, banks shouldn't get to that extent, and therefore they have to price more sensibly.
Earlier you said you didn't think that Ireland was going to go bang.
No.
But there is systemic risk there. If they don't take the bailout, and of course, politics may prevail. There's that political pride in this environment. There's obviously huge exposure with the UK to Ireland.
Sure.
What are your thoughts if we look at worst case scenario? Or is it not even possible in your book?
No, I cannot see it as possible. I think that, you know, twice Merkel's caused a run on Europe by making statements for political purposes because she's fighting elections. And she did it again the other day, and that caused this latest bout. I think the Irish have been playing brinkmanship, but I think their game is now over. They're going to have to take the money. They have a responsibility to Europe to take the money. It doesn't matter whether they need it or they don't need it. The world thinks they need it, and they're going to have to take it. You heard the Prime Minister today say, we may take it, but we may not use it. So I cannot see that they're not going to take the money. The money is there. The structure's there for them to take the money, and they're going to have to take the money. And they know that. But they're just trying to extract maximum. They don't want to have too many rules imposed on them, like up your corporate tax rate, then all the international businesses that locate there disappear. Because 87% of the Irish economy is fine. It's the financial economy and the property economy that's blown up.
I mean, Stephen, when you look at the whole world situation, especially in Europe, I mean, we've got Ireland, we've had Greece, we all know these stories, but at the end of the day, Germany is strong enough to bail them out. Why is everyone so worried? And Germany will, because they're the architects of the euro and they don't want it to collapse. So the politicians might make noises, but they're going to come to the party with money, and they've got the money.
And there's another side of the coin that says it basically suits them, because imagine what they would have a DM, a Deutsche Mark. The export businesses would never be anywhere near. They are making a fortune at the moment because of a weak euro.
This is their best recession they've ever had.
Absolutely.
They had the one bubble burst, the -6%, and then it's roared.
So David, you wanted to make a point there.
Coming back to Investec, I think the one disappointment was Australia.
Yeah.
Against an economy which was doing pretty well, where interest rates were going up. You know, I would have thought you would have seen a much greater contribution. How are you going to bulk up that business? I mean, particularly with your success in South Africa, where it's pretty much the same culture.
Yeah, I think that we've just got one business dragging us down there, and this 6 months, if you talk to anyone in the investment banking industry in Australia, very little went on. You know, it started picking up now, but not in the 6 months. 6 months were very choppy from an investment banking point of view. Remember, equity markets did not perform until the last 15 days of September. Before that, they were all over the show. So that's not good for deals. We're starting to see a lot of pickup in deals, but what we're still suffering from is the backlog of clearing problem loans. Australia is one place where you can sell things. They buy, so you're able to clear them. But it still takes a lot of time. And there was an absolute property bubble in Australia. If you look at the property funds, none of them behaved like a growth point, you know, which leveraged 30% and gave people a good return right throughout the crisis. Share might have dropped down to 11, but it's come back to above crisis levels. They went to 5% of their value. These guys were running property hedge funds. They were doing all sorts of crazy things. It just blew up, boom. And unfortunately, we had a book in that kind of space. And so that's what we really did.
What was it?
Man, you had Babcock Brown, you had you had Allco. They just blew up. You had Macquarie's funds blow up. You had all sorts of things go crazy in that market. All the property funds, boom, gone.
But then the question is, you can buy an Australian property fund now at a higher yield than an SA one.
Yeah, you can, because there is still they do it differently. Yeah? You know, we learn in life that everyone's not the same. They don't calculate, yields are calculated differently. So you actually knock off 10 or 15% of that yield, and you'll get to an equivalent.
Talk to us a bit about the South African Property Fund on the table.
Yeah, we just, you know, we've got a good property division. We think it's time for us to launch a listed fund. So we'll try and do that next year.
I was going to ask you about timing. You answered my question before I got there.
First
and
half
then
of next year, if life's okay.
Mohammed Al-Arian, the CEO of PIMCO, and I think viewers are tired of hearing me quote him, but he coined the phrase the new normal, which is that anemic growth in the developed world and that emerging markets are going to be dominant for a long time to come. Is that in any way changing your strategy? Is there value for you to unlock in emerging markets if this is the way of the world going forward?
Yeah, we just see ourselves as a bridge between those markets because we have a business in a developing market and in a developing continent. We've always had offices in Hong Kong, Beijing, so we do transactions in that kind of space. We have another business in a developed market that performs very well from growth in developing markets, which is in Australia, and then we have a business in the major capital centre of the world. So we see ourselves as a bridge, and being able to bridge between the different continents and to capture transaction flow. If you've seen what Investec Asset Management have done in Africa, they're one of the biggest fund managers outside of South Africa, managing African money from, not from Africa, money from the developed world that wants to find a home in the developing world. We manage money in China in the same way, and we manage money right around the world. Now, on our investment banking front, we think that's where the next opportunities for us is to participate in those flows. And I think we have a good brand in those countries. They know our brand quite well, and I think we're able to capture some of those flows. To go and lend money there, not for us. Every time we lend money away from our core, we get a hiding.
The proverbial question that we have to ask the CEOs across the board, is there anything, Stephen, that keeps you awake at night at the moment? Or is it a host of issues in the current economic environment?
I'm fairly relaxed. I think, you know, if you asked me a question 2 years ago, I would say lots. But I think that the world has moved from the precipice to dealing with the issues. I think that is a very long way. We've come a very long way from where we've been. And I do feel a lot more confident about the stability and the ability to deal with what is out there. So I do feel that things are improving a bit. You know, even if you have anemic growth, there are lots of opportunities inside that anemic growth. In fact, again, I'll quote Paul Krugman, who was at a conference of ours the other day, and he said that when you look at the macro picture of Japan, it looked terrible. When you were inside Japan, people were still getting wealthier. And even though things were going, you know, nowhere for 20 years. So if you were a holder of stock, you felt sick, but if you were operating in the economy, you were fine.